Okay, today is Thursday, the 26th. We'll just 4 more days left in September before we get into October. And fall is indeed upon us. All right, so what are we going to do today? We're going to continue our coverage of chapter 3. There was a homework assignment that we had today that we'll go over. And then we're going to continue to move into coverage of these adjusting entries, practice preparing some of these today and kind of tighten that up a little bit, which will lead us into, the homework I give you for class next Tuesday. All right, so first things first, before we do anything, I'm going to go into content and I'm going to scroll down to the chapter documents. All right, and you don't have 3 available. You should have 3 available. Oh, let me fix that. Second here, and I'll fix something that I thought was already in place. All right, well, let's make it in place here. All right. Visible, there we go. And so I'm going to pull up some stuff that we had last time. And related to that. Okay, so all right, so we had, oops, and my link went away. Okay, let's grab it back. Hold on 1 second, I'll be right with you. All right. All right, so where we are now, just as a quick reminder, first thing I want to get into is I'm going to go ahead and review everything here. All right. So the only thing I gave you in our last class was I deployed the first exam. All right, and so I guess I'm going to start with that. Our first exam is due, as a reminder, you're going to go down here and click the exam 1 here area. Although I have this listed in the assignments as well. The assignment I gave you for the last class, was to work on the exam. So I'm going to go there first, and then we'll go down to the exam 1 area. Okay. So in our class, am I in the wrong section? I'm in the wrong section. Yeah, we don't have class on Wednesday. All right. Yeah, I'm in the 2 101 sections and I'm in the wrong one. Yeah. That's right. Yeah. No, you guys already did the exam. Yeah, okay. We've already started chapter 3 for crying out loud. Okay, yeah. Yeah, I'm thinking, no, something's not right here. Okay. And that something is me. I'm not right today. All right, I'm having trouble. Sorry about that. All right, so when I click into assignments, no, the exam 1 is already over and done with. All right. So where we are now, we got our chapter 3 homework. We'll go over couple quick things about the exam. I've started a review of that, and I've been working it into my offline Excel gradebook. And my hope was that before we had class today to have the gradebook updated. That was my intention. In fact, I told you on Tuesday that's what I was going to do. And so if you were anticipating getting an update on your course grades, the only thing I could say for now is just keep anticipating for a little while longer. And I will have that up and running here before the end of this week is out. More than likely at some point this evening. So that's coming, and I'll update the gradebook for our first exam, and then all homework to date, which will be everything all through chapter 2. And then I'll even throw in this one that I had due for today's class, this first homework for chapter 3. All right, so just a little reminder of that. And I see something in the chat here. Yeah. So no, I had a little, absent-minded professor moment. Well, I was in the wrong course, basically. I got my two 101 sections. I got you confused with my morning class. All right, so that aside, we're just going to continue on with chapter 3. And to that end, I'm going to go in chapter documents here, go down to chapter 3's folder. And you remember that we've in the video lessons area, and I'm going to keep drawing attention to this because it is something that we are going to continue to use as we continue to work on preparing adjusting entries. I'm going to pull up this lesson here. I'm actually going to pull up two of them. So I have one, so we can have the list of adjusting entry types. And then another one is going to be walking through the templates. Okay. So just to review a couple quick things to get us back up and running here. And so a little bit of repeat of what we had on Tuesday. And I'm going to use this area to do it. So we need the adjusting entries just as a quick review, because when you first start learning this stuff, it's like when we learn transactions and how they're journalized, great. Putting them into the ledger accounts is just like kind of sorting everything out and putting it where it needs to go. All right, I understand that. Chapter 3 is that chapter where until we kind of revisit why these things are being done, it's hard to understand the how part, okay? So part of understanding this is not just like, oh, I got to learn these entries, I got to crank through this and do this. Yeah, that's part of it. But you can't have the how part without the why part. Those two things need to merge together. So you know, as you're doing these adjustments and getting the numbers that you need to get, you need to have an overall concept as to why you're getting those numbers to begin with. It has to make sense. It has to be something that you're able to, you know, develop some process for or understanding of. So here's the deal. We know that an accounting cycle is a specified period of time. We go from, you know, the beginning of the period to the end of the period. At the end of every accounting cycle, which we know, if I can kind of go through that, that cycle can really be any duration. It could be yearly, it could be quarterly, you know, monthly, as the 3 examples I got here. And at the end of whatever that cycle is, no matter what the time frame is, we have to make sure that all the balances of our accounts are, you know, caught up, so to speak, and everything that happened in that time frame, no matter what length of that time frame it is, that we make sure that those things are in there. All right. And again, I use the analogy of telling a story, right? We want to make sure that we are telling all of the story, right? We're not leaving anything out, okay? Because you know that when we evaluate the value of good information, part of good information is full disclosure, knowing everything that, you know, is important for the decision-making that we want to do. So what happens is we've got a number of things that happen during the cycle that require us to make an adjustment at the end to make sure that we're updating everything and recognizing everything that needs to be put in there, okay? So 2 important things that we comply with, okay, is we want to make sure, and this also coincides with this other screen over here that I got. We want to make sure that, whoops, let me see where I was, there I was, that these 2 important things we're complying with, okay? So the first thing we try to do or want to do with these adjustments is we've got some revenues that haven't been recognized. And when I mean recognized, they haven't been put in the accounting records. All right, we have some revenues we haven't recognized, and we got to make sure that we get them journalized, and now they're in the system, and we can make sure that they're you know, part of our balances. And then we also have expenses. Again, these are things that, you know, either we have to charge off as expense or stuff that is just over time accumulated, and we got to make sure that we put it in the records, okay? So that's really why we're doing this. And then when we see some examples, as we're going to continue to work on today, that'll, you know, be a little more easier to understand, okay? So now the other side of this is this. If we didn't do this process, if we didn't complete these adjusting entries, a lot of our accounts on our books are not going to be the balances they're supposed to be, all right? Some of our balances are going to be lower than what they should be. Some of them are going to be more than what they should be. And again, this is all about trying to present a picture to anybody who wants to look at our financials, a really accurate picture, as accurate as possible, all right? So to that end, we follow what we call accrual basis accounting, okay? So now one of the things I want to do in this class that I didn't do in the other one is I want to take, open a blank Word file here and give you some notes related to some of these things that we talked about last time, okay? So I'll call this, of course, Chapter 3 notes. And I'm going to give you some information that we talked about last time that is going to really kind of tighten some of this down, all right? All right, so the first thing, we have the accrual basis, and then we have cash basis, okay? We're going to start with the accrual basis. We'll call it accrual basis method for accounting, okay? So for any of these situations, we have to know how is revenues and expenses recognized, all right? That's the burning question, all right? So under the accrual basis method, all right, and actually I'm going to take that and cut that out of there, and two of these methods answer that question in different ways. So first thing I would say with accrual basis is revenues are recognized when earned. All right, and what I mean by that is when the job is performed, when the service is provided, that's when we book the revenue. All right. And so I'll put in parentheses when service is provided or work is done for a customer. Okay. And that literally is the revenue recognition principle. Okay. All right, that's what that is. So the revenue part is all about, did you do the work? Okay, that's the most important part there, right? And following that, expenses are recognized when incurred. So, and then I can think of that word as occurred. Right? So when you use a service of another company, or you get billed for like utilities or your telephone or whatever, you know, you've used those services, you've incurred those expenses. Okay, you've incurred those expenses. Now, again, it doesn't matter if you paid them or not. That does not judge whether or not you recognize them. It's all about whether or not you got the bill. And that is the thing that dictates whether it gets recognized. So this, I'll just say, bill is received in the mail. Vendor provides an invoice charging the business, I should say, for services used. I'm just coming up with some examples that would really kind of drive that home. And in this, we call the expense recognition principle. Okay. So we've got the revenue recognition principle, the expense recognition principle. All right. So our focus here is, you know, what is the criteria that judges whether or not we record revenues or expenses? Now, for accrual basis, that's how that is. All right. Now, what I'm going to do is I'm going to copy this whole thing, and I'm going to go down because I want to kind of keep that format that I set for myself there. I'm going to paste this in, and we're going to change this, and we're going to call this cash basis. All right. And I'm just going to go in, all right, and delete everything right up to the when part. Okay. And then we're going to look at this. So when we follow the cash basis method, revenues are recognized when cash is received. All right. So the problem with that is we may have performed a service, and I'm actually going to put this in the notes so you have it. We may have actually performed a service, but we don't book it, even though we did it, because we didn't get the cash yet. All right. So I'll write that here in a moment. And expenses are recognized with cash is paid. All right. So the motivating factor for recognition of revenues and expenses, excuse me, sorry, following the cash basis, it's all about money going in, money going out. Okay. So which is better or more accurate? That the answer would be accrual basis. All right. And then the question would be, why? Why is it better? Cash basis leaves out important revenue and expense activity only because cash was not involved. This does not change the fact that the revenues or expenses have occurred. They have, all right? So this is why cash basis is not generally accepted accounting principles. Okay, or otherwise known as GAAP. All right. And so here's the thing. You may have a business that, you know, had over $100,000 in revenue, but under cash basis, they only recognize $20,000 of it because that's the only amount they got paid in cash for. Now, the question is, if we're following that criteria to judge whether or not we have revenue or not, is that really an accurate picture of what the company did that year? No, because they generated over $100,000 in value of revenue. And if we're only looking at the stuff we collected cash for, we're literally leaving out most of the story about the company. Okay. So if you get an investor that's looking at the company, has no idea that the company uses a cash basis, they might look at the revenues and say, oh yeah, they only have 20,000 in revenue, when really they have 100,000. Okay. This is a huge problem because you're leaving out part of the story. You're leaving out some of the important activities the company did that year that really shows you how well they're doing. Okay. This is why cash basis is not good. Right. And for the same thing with expenses, if you're only recognizing what expenses you pay, then you're leaving out part of what you owe. You're leaving out part of the story about what the company's on the hook for, but that they didn't pay for yet. All right. Now, I have friends that are terrible with their personal finances. And, you know, one technique they use is they only think of the bills that they pay. So if they get a bill in the mail and they throw it in the drawer and forget about it, it's not an issue with them because they didn't, you know, what falls on their radar is the money actually going out of their wallet or purse, right? But that doesn't change the fact that they don't have those costs. They don't have those bills. I mean, when they're sitting there in the house and suddenly the lights go out, then they realize that they forgot to pay the electric bill. That didn't happen, but I'm just using it as an example, okay? And another famous technique, some businesses do this, is if you have 5 bills to pay and you only have enough money to pay 4 of the bills and maybe a little bit of the 5th bill, you pay the 4 bills, and instead of setting the rest of the money aside towards that 5th bill, I've heard individuals say to me, whoa, wow, that's extra money. I'm like, no, that's not extra money. You didn't have enough money. So the fact that you don't have enough to pay that 5th bill, that doesn't mean that that money that you could possibly contribute to it is now extra, and they take that money and spend it. And, you know, it's just literally, you know, two different ways to look at the same thing. All right. So that's why cash basis is not really a good method. Okay. So the question is, why are we learning about it? Some businesses use it. Maybe that's what you were just going to ask.
I was gonna ask why they still use it if the other method is objectively better.
Yes, yes, great question. In fact, before you even brought that up, I was going to, you know, address that. Now, some small businesses, as I said last time, operate strictly by cash. They don't have to follow rules mandated by the SEC, the Securities and Exchange Commission. They don't have to follow the rules of the road for being a corporation or anything like that. They're a small mom and pop shop, and they operate. I brought up an example of a local ice cream stand that literally the only way you can get ice cream is you come in with money. If you don't have any money, you're not getting any ice cream. Okay. They don't take debit cards. They don't do Apple Pay or Google Pay or whatever your cash app you've got. It's cash and carry. All right. Which is an old phrase that is slowly but surely getting outmoded. A company like that could follow the cash basis because they're looking at money coming in, money going out. Yeah. And that's the way they can look at it. And so it is something that you can do. In fact, QuickBooks, which is one of the popular accounting software packages out there, software, offers you an option to toggle on the cash basis approach. All right. By default, the accrual basis is turned on, but you can actually force QuickBooks to treat everything on a cash basis. So it is still something that is relevant. It is still something that some businesses use. But at the end of the day, if you follow cash basis versus accrual, you are leaving out part of the story, plain and simple. You are leaving out part of what happened to that company because the criteria that you're using does not follow what actually happened. All right. So, and then accrual basis is the method of choice. Oops, I can spell choice. I'm not centered on the keyboard. That's why. And the method we will assume and use. All right. So, and actually, here's the cool thing. Everything you've done since the very start of this class, you've been following accrual basis. We just didn't put a name on it. All right. But now we are. All right. So knowing that, we have to record revenues when they're earned and expenses when they're incurred. Okay. Whether or not cash is involved, this is the foundation of why we need to make adjustments. Okay. Excuse me. We have to comply with revenue recognition. We have to comply with expense recognition. All right. And when the end of the cycle hits, we've got some expenses and revenues that weren't put in the books for various situations, which we're going to continue to explore today and do entries for. All right. So this gives rise to these adjusting entry types that we got. Now, homework I gave you was very simple. It was just identifying a transaction as one of the possible types. All right, we worked on this at the very end of our class on Tuesday, and we're going to start with that because the first thing you got to do is when you're going to prepare an adjusting entry, you got to know which one you're working with. All right, because if you don't know what type you have and what category underneath it you have, you're kind of like flying blind. So if you remember, we got two different kinds of adjustments we make. We have stuff called deferrals. And what a deferral is, as we remember from last time, is you could think of a deferral as a delay in recognizing either a revenue or an expense. All right. So thinking in that realm, we've got unearned revenues. So this is one type of an adjustment. So what happens is customer comes in, pays you up front for work you haven't done yet. You're going to do it either next month or next week or whatever. And you basically create a liability at that point. You owe the customer the service. So we recognize that unearned service revenue account. Okay. Yeah. Yeah. Well, we'll get to prepaid expense. Yeah. Let's hang on to just the unearned revenues because I don't want to get the two confused. But no, finish your sentence. I interrupted you. Sorry.
The prepaid expenses basically, you give it in the cash out, the company, and they're just looking under the cash and using that to pay for that thing over time.
Kind of, sort of, on
Yeah.
that part, but we'll get back to that. Let me circle back to that. So an unearned revenue, why do they call it a deferral? Well, the revenue that you recognize, okay, remember when we go back to the notes, we're looking at recognizing the revenue, okay? And we only do that when we earn it. So if somebody pays us up front for work that we haven't done yet, there's a delay, or again, a deferral, where we are waiting for that revenue to occur, that recognition to occur. And again, under that rule for revenue recognition, you can't book it as revenue until you've done the job, all right? So the deferral or the delay is in doing the work. And then once you do that, then you could book the revenue and get rid of the liability. Okay, so there's one deferral. The other one, prepaid expenses. And this is kind of a misnomer because you're thinking about expense. Well, you look at it this way, and I'll take a basic example that's really good at kind of putting a picture to this. A company buys things up front that they're going to use. Okay, they might buy cleaning supplies, office supplies. Let's just think office supplies for a minute. So they buy everything up front. The supplies come into the business. They go into the supply closet. All right, and that becomes an asset. All right, if you remember, the definition of an asset is anything that the company has that's a resource that they own and can use, one, and two, it has future value, okay? So those are the two criteria that you look at. So if we buy those office supplies up front, they go into the closet, there's a resource ready to be used by the business. It has future value as long as we have supplies, right? And then the question is, the deferral part is eventually, after those supplies have been bought, we're going to start using them in the daily activities of conducting our business. We're going to use the pencils, the pads, the Post-it notes and reams of paper. And that becomes a normal business cost, all right? In order to conduct business, we have to expend or use these office supplies. So where we call this a deferral is because this asset that we bought up front and then we start using later, we have to charge to expense, all right? We have to charge to expense. And again, why charge it to expense? Well, I had to use pens, pencils, paper to do my work in my business. And that's a business cost, just like anything else, right? Using the electricity in the phone, it's all costs that you have to incur in order to have your business, okay? So that's why those two things are deferrals, right? There's a delay in recognizing either the revenue or the expense, right? And the accruals, and again, the thing that you can think of with that, and this is another thing for notes that I'll put in here, is this. Well, I want to give this to adjusting entry types. So I'm going to put that, and I'm going to give you some questions that you can ask yourself for each one of these. All right, so the first thing would be deferrals. And we got two, got the unearned revenue. So part of the goal here, and once I give you these questions and we kind of dig into this a little more, then we'll take a look at that Wiley Plus homework. The question here is identifying these things. All right, I kind of loosely did that just now. All right, I'm trying to find my mouse. There we go. All right, so first one is deferrals. All right, unearned revenue. And what you would do for this, you'd ask this question. Did we receive an advance payment from customers? All right, so that's the situation that creates the unearned revenue liability that we are now earning by performing the service. All right, that right there is a question, you can ask yourself to help you, see that situation, because part of the battle here is understanding or recognizing that, okay? I mean, you have the nice little handy dandy illustration here with all the, little 4 bubbles with the types in there, but what are they? All right. And we have a little bit of a definition here in the wording, but what I'm trying to do here is, the beginning of wisdom is asking a question, right? And engaging your brain by asking a question engages your brain to actually try to answer the question. So this is a way to kind of get you thinking, does this situation exist? If it does, then that's what I've got for an adjustment. All right. And then how about, you know what, I'm going to knock all this down to another line because I want it all on one page here. Yeah. And I'll clean it up later before I post it. All right. So then the other deferral is a prepaid expense. All right. And here's a good question for that. Did we acquire an asset up front that we will charge to expense with use later? All right. So this is a very important thing for identifying if you have a prepaid expense. Now, some very popular examples of this would be the purchase of supplies. All right. Any kind of depreciable assets. We'll talk about that at some point today, what depreciation is and what that means. Where's that? Acquire an asset. Thank you. Yep, that's supposed to be an asset, not and asset. Yeah. Yep, that's a little typo on my part. Yep, thank you for drawing attention to that. Yep. Anything you see that looks weird like that, please bring to my attention. And because I'm typing on the fly, I could have some spelling errors or usage errors in there. And sometimes Word does that to you, or Word like corrects it what it thinks you want. And yeah. So. And Siri does that too. And the annoying thing with Siri is that, there is a blue sky and it'll say there was a blue sky. I'm like, no, I didn't say was. It's is. Stop that. So a little annoying thing there. Which makes me wonder when they release this artificial intelligence deal, or Apple Intelligence as they're calling it, just how much more intelligent is it really going to be? We'll have to see. And then, so now let's get back to the accruals. Okay. All right. And, up here with deferrals, I could put a general definition. The recognition is delayed. That's the best way to think of it. The items in question for accruals have accumulated. All right. And that is the key there. Okay. In fact, I'll put a little quote around that. Yeah. So you could think of accruals as kind of like accumulations, something that's accumulated. All right. So here we have accrued revenue is the first one. And here's a question for this one. Did we perform a service but have not yet recorded it? All right. There's a situation that can cause that to happen. All right. So yeah, if you perform a service for a customer, but they weren't invoiced or billed yet, yeah, you got a problem there. You got something where, yes, you did earn the revenue, but you didn't put it in the books yet. All right. So you did the work. There's no question about that, but you just didn't record it yet. All right. And then an accrued expense, same deal. Did we incur an expense but have not yet recorded it? But have not yet, not year? What do we get year for? Not yet recorded it, but have not yet recorded it. Again, that's a question. Right? So When we look at accruals, we are looking at accumulations. You know, stuff has gathered up over time. So let me go back and give you some examples of this. Okay, well, unearned revenues, that's pretty much self-explanatory, but prepaid expenses could be, you know, purchase of supplies, depreciable assets. I'll put that for now, and then I'll dig into what that means later. All right. Or any other prepaid item such as rent or insurance. Yeah, because you can prepay your rent on your facilities upfront for a year, sure. You can prepay your insurance. All of us that has car insurance, we have the option, they give you an option to pay everything up front. In fact, they even give you a discount. If you pay your entire balance up front without, instead of monthly installments, we'll give you 10% off. You know, but most of us don't do that. We just pay it little bits. I know I don't do it that way. All right, but you have that option. So you could prepay for some things. Again, when you do that, they go on the books as an asset. And then as we use them up, we have to charge them to expense. All right. Insurance and rent would be two things that we'll definitely look at. All right. Some accruals, what would be an accrued revenue? I mean, that's again, just like unearned revenues, it's pretty self-explanatory. You did a job, you didn't book it, there's your accrued revenue. What about an accrued expense? Some great examples of this is salaries and wages. In between a pay period. And I'll just put accounting cycle ends in the middle of the pay period. All right, we even just saw an example of that in the notes from last class, right? Here's another example. Interest accumulated. All right, there's another accrued item. You know, as time goes by, interest accumulates or accrues, okay? As we sit here, wait a minute, wait for it. Interest just accumulated. Interest is a function of time. So the more time that goes by, either benefiting you or not benefiting you. If it's, interest on a loan you took out, it's not benefiting you. If it's interest on an investment that you've made, then that's benefiting you. So, but either way, interest is accumulating. And what we're thinking about here is the cost of borrowing money. So if we borrowed money from the bank and secured a note, a promissory note, and generate a note payable on our books, which is a liability account, as you know, and then we accumulate, you know, again, the bank's not going to lend us money for free. Sure, we got the 10 grand we borrowed from the bank, but as we have it, we're going to have to incur interest costs on it. All right. The longer you borrow the money, the more interest you're going to pay. So interest is a function of time. And the more time that goes by, the more you're going to owe. All right. The balance you borrow obviously has an impact on that. You know, the larger amount you borrow, the more interest you're going to pay. But the thing that really is not in your favor is, you know, a 5-year car loan is going to have much less interest than a 30-year mortgage for a house. All right. And that would be true even if the amounts were the same, which they never could be. I mean, you know, what's a car go for, a decent car to go for these days? Around 35 grand, you know, brand new, although they're higher than that now. And you're not going to buy a house for 35 grand, but assume those numbers were the same, exactly the same. The 5-year loan versus the 30-year loan, you're going to pay way much more interest on the 30-year loan because it's a longer gap of time and interest is a function of time. A perfect example of an accrued expense. All right. In fact, we'll see it and work with it today. All right. So now one of the things I want to do is I might zoom out a little bit and I want to come back to these notes. Whoa, what the hell did I do? I went way out. Boy, I zoomed all right. I zoomed way out. Okay, I totally upset the apple cart there. I turned on the outlining feature. All right, how I did that, I have no idea. Actually, I think I know. I hit the wrong button. Here we go. All right. Next month, I get my eyes checked, and I might be wearing bifocals. So if you see, Professor Merriman take a tumble down the stairs, now you know what happened. Because apparently I was told that's the worst thing. When you get bifocals, when you're good when you're walking, but you go downstairs and it seems like you're diving down the stairs because of the way that the bifocals line up vision-wise. So here's what I'm gonna do. I'm gonna have both pairs. I'm gonna get the regular, I'm in the denial and don't need bifocals pair, and then I'm gonna get the bifocal pair. And so if you see me fall, and as you're tending to me before the ambulance arrives, you can ask the question, were you wearing bifocals? All right, okay. Painting a real beautiful picture there. Oh, okay, it does make me feel better. Thank you. Yep. Yeah, some people have them a lot earlier than others, but me, I should have had them 10 years ago, and I'm in denial, I guess, because I just don't want to have I don't know. And I'm sure that once I get them and I wear them for a few days, it's not going to be a big deal, but I tend to be a big baby about that stuff. All right, I'm going to leave these notes up. And then I want to take some of these questions, maybe come back to them. But the first thing I gave you was a homework that was just identifying what type you had. Now, before we do that, I want to go back to here. And we had everything categorized by deferrals or accruals, but I told you there's no way you can do this. 2 of those adjusting entries are related to revenues, and 2 of them are related to expenses. So we can kind of recategorize this. It's not like the deferrals and accruals went away. They're still there, but we can look at this from a different point of view. We could say we've got 2 transactions or 2 adjusting entries that are related to revenues and 2 related to expenses. Now, the cool part about that is this. First question you ask when you read a transaction is this revenue related or expense related? No matter what your answer, you're going to eliminate 2 of those 4 things. And now you're down to just 2 left. Then you can figure out from there what you've got. All right. Between that and the notes that we just created that I have, all formatted in there nicely fitting the screen, let's go ahead and go into the homework that I gave you and see how that went. All right. So this is a skill building thing. I want to be able to go in here and, some of these you might have gotten correct. Others you might not have gotten correct, but that's okay because the first order of business, the first skill we need to develop is to basically identify what we're working with. All right. Once we know what we're working with, then we could follow the template that we're going to revisit today to figure out what the debit and what the credit. All right. And then the number that we need, that's another piece of the puzzle. Okay. All right. So we've got this one right here. Let me zoom in on it a little bit. Okay. And did you guys have the solution available? Looks like I didn't make the solution available for you. That's okay. We're going to do it now. And I'm going to make sure that's available for you. All right. I don't see it there, but I'll make it available. But let's go and work through it. So identify, well, first, Luong Corporation, that's how I'm going to say that. I don't know if I'm saying it right, encounters the following situations, right? Identify what type of adjusting entry, there's our 4 that we have learned about and talked about, is needed in each situation at December 31st, 2027. All right. So first one says, all right, remember, we're going to kind of practice this little technique. Luong collects $1,300 from a customer in 2027 for services to be performed in 2008. So when I go over to here, is this revenue related or expense related? It is what? Revenue. Okay. Now we're down to accrued revenues or an unearned revenue type situation. Which one would it be? It'd be unearned, right? So we're receiving money up front. There's a delay in the recognition or a deferral, if you will, of the revenue. And we're going to recognize it later when we actually perform the service. Yeah, so for the answer for the first one would be an unearned revenue type of an adjusting entry, all right? When we're done with this, I'll make sure the solution is available so you can actually see the text in the fields here. But right now, we're just kind of working through it piecemeal. Let's do a couple more of these and, and then we'll do a few more and then we'll take a break and kind of finish it when we get back. Luong incurs utilities expense, which is not yet paid in cash or recorded. So expense or revenue related, it is what? Expense. So then is it an accrued expense or is it a prepaid expense? So we go to our questions. If it's a prepaid, did we acquire an asset up front that we will charge to expense later? All right. Or did we receive, or is it down here, the accrued expense? Did we incur an expense but have not yet recorded it? Which one more closely matches what we're looking at? And I'll go back to the question here. Let's see it again. So we incurred utilities expenses, did not yet pay them in cash or record them. So the definition of a prepaid asset is, did we acquire an asset up front? All right. And would utilities be an asset? Does that make sense? Now, Carlos has got a choice already in Zoom. Excellent. So no, utilities are a cost, right? They're not an asset. All right. The only way that could become an asset is if you prepaid for your utilities for the next year, although that's hard to do because you don't know what energy you're going to use. So that doesn't match up, does it? So, but this one does. We did incur the expense. It did happen, but we haven't recorded it yet. All right. So the second one here, number 2, would be an accrued expense. Okay. Now here's one thing I'm going to say. If you're fuzzy on some of these, don't worry about it. All right. This is ground level stuff. We learned the basics of what the setup is. And now we're just trying to apply it, to figure out what we were dealing with here. Okay. The more you do this, the better it's going to get. Okay. Practice makes perfect. So this is just the first of a few things that we're going to do to tighten that up. Luong's employees worked 3 days in 2027, but will not be paid until 2028. Is that revenue related or expense related? Expense, that's pretty easy to spot. So are we talking about an accrued expense or are we talking about a prepaid expense? Yeah, this is an accumulation of cost. We didn't buy an asset up front that we're going to charge to expense later, okay, because that's what a prepaid is. All right, yes, that would be an accrued expense. All right. 4, Luong performs services for customers, but has not yet received cash or recorded the transaction. And subsequently, the accountant was fired. No, I'm just kidding. Is that revenue or expense related? Revenue related. All right. Are we talking about an unearned revenue or an accrued revenue? An accrued. Yeah, we did the work. We just didn't put it in the books yet. All right. All right. Unearned revenues is all about a delay in performing the service. Although we might see one of those where they actually do, excuse me, perform the service later. Let's look at number 5, and then we'll go ahead and take a short break here. So 5 says Luong paid $2,800 rent on December 1st for the 4 months starting December 1st. So are we dealing with a revenue or an expense thing? Which one is it? It's an expense. All right. Now, so now we've got these 2 guys here, but let me go to my definitions. Is it a prepaid expense or is it an accrued expense? Which one matches better? Yeah. Did we acquire an asset up front? Yes, we did. When we prepaid, let me go back to that. When we prepaid the rent, all right, we paid up front for it, and the rent goes on our books as a prepaid item, which is an asset. This is something that we have that is of value, and it's going to benefit a future period of time. Well, until we use it up, right? So yeah, this is something that goes on the books as an asset. And then as we start using it, we're going to charge it to expense. And again, more generally, that would be a deferral. We've delayed the recognition of the expense. All right. Why don't we stop there for a moment? And let's take a 10-minute break. All right. When we come back, we'll continue on. I think that's a good place to kind of take a breather. All right. So 10 minutes, folks. I'm going to go ahead and pause the recording. We'll come back in 10 minutes and we'll pick up where we left off. So we're back from the break. Let's go ahead and finish this. We're identifying what adjusting entry types we had. So Let's go with the next set. So starting with 6. Luong received cash for future services and recorded a liability until the service was performed. Revenue or expense related? Revenue. And actually, which one would it be? Would it be an accrued revenue or an unearned? Yeah, in fact, honestly, if I went back to that statement, that's the definition of how that unearned revenue situation really comes about. Yeah, so I think that's a good definition. How about 7? Luong performed consulting services that is for a client in December 27. On December 31st, it had not billed the client for services provided of $1,200. Revenue or expense related, it is revenue. And which one would it be? Yeah, we did the work. We didn't book it. All right, so that's accrued revenue. Luong paid cash for an expense and recorded an asset until the item was used up. Is that a revenue or an expense related thing? Expense, and which one would it be there? That's a prepaid item, yeah. And actually that, again, for that one is pretty much the definition of what creates a prepaid expense right there. That's what creates it. Good definition of it. 9, Luong purchased $900 of supplies in 2027. At year end, 400 of the supplies remain unused. So would this be a revenue or expense related thing? An expense, and which one would it be? Yeah, and again, if I can go to my notes and look at that, we bought something up front that was an asset, and then as we use it up, we're going to charge it to expense. All right, so it'd be a prepaid expense. You got it. Luong purchased equipment on January 1st, 2007. The equipment will be used for 5 years. Okay, so is this a revenue or an expense related thing? An expense, and which one does it more closely fit? Yeah, so again, let me go to the notes. And we bought something, the equipment goes on the books as an asset, as it must go on the books as. And then instead of using it up, we depreciate it. Okay, so we depreciate it. All right. And we'll talk about depreciation as a concept, what that actually means here in a moment. Okay, because that's something that I want to dig into a little more. What else we got left there for the problem? I think we're almost done. Well, last one, Luong borrowed $12,000 on October 1st, 27 by signing an 8% 1-year note payable. Both the interest and the note will be paid in 1 year. So is this revenue or expense related? It is expense. Which one does it closely match? That's an accrued expense. Yeah, because the interest is going to accumulate over time. Yeah. All right. So there you go. Identifying what we got. And, now, kind of taking it one step further, let's take that skill that we practiced and do something else with it. So I'm going to go ahead and close this out. I'm going to go ahead and open the ebook, and we're going to take, for the second part of class, we're going to, grab an exercise at the end of chapter 3, and we're going to prepare some of these adjusting entries. So that's the next step. All right, so first off, let me zoom in on that a little bit. It's pretty tiny. All right, so chapter 3, we'll go to the end of the chapter material, and I'm going to look for an exercise that might fit the bill nicely. There's the one we just did. All right, let me see. I like this one a lot. So we're going to use this exercise 3.5, and I'm going to give notes for this, because this is where we start digging into the mechanics of applying this, right? So this would be exercise 3.5 on page, and we'll get an ebook page for this, so you have a point of reference, 3-46. 3-46 in the ebook. Right? And I misspelled ebook. Oh, they want it with a capital B. Gotcha. All right. So let's go ahead and read the information here. It says Devin Wolf Company has the following balances on the selected accounts. Okay, we have a laundry list of the balances. All accounts have normal balances, which we always assume. Okay, but information is good to know. The information below has been gathered at December 31st, 2022. Interest will be paid when the note is repaid. Okay, good to know. So what I'm going to do for this problem is I'm going to take each one of these adjustments. All right, I'm going to copy it and I'm going to pull it into our notes here. Okay, because this is something I want you to have narrative for. Okay. So Devin Wolf Company borrowed $10,000 by signing a 9% 1-year note on September 1st, 2022. All right, before we do anything, what is the time period assumption for this business? All right, let's answer that question first. So when I go into the problem, all right, these are balances as of the end of December 31st, 2022. Okay, so down here, prepare the adjusting entries. Okay, and here's the most important piece. All right, Devin Wolf prepares the adjusting entries annually. All right, which means at the end of every year. So now we know the time frame, the accounting cycle. In fact, I'm going to copy that in. Okay, put it in our notes. Oops. This means they follow a 1-year accounting cycle. All right. So that's important. Before you do anything, you have to figure out what their time period is, because some of these adjustments are going to rely on the amount of time that has gone by. Some of them won't. All right. And you have to really lock that in. So now that we know our time period assumption is 1 year, or, a full or annually, now that we can do something with that. So we are going to put this, all adjusting entries, I should say, are prepared at December, whoops, wow, that went south. There we go. 31st, 2022, I think it was. All right. All right. So that's another important thing. So we'll call this adjusting entry number 1. All right. All right. So Devin Wolf borrowed the $10,000 by signing a 9% 1-year note on September 1st. All right. So is this revenue or expense related? It is what? We're talking about borrowing money. It's not really about performing a service, right? So it'd be expense related. Now, are we talking about an accrued expense where the expense kind of builds up over time, or are we talking about a prepaid expense where we put something on the books as an asset and then start charging it to expense as we use it up? It's an accrued expense. That's the one that makes most sense. In fact, we're talking about interest here. So I'm going to put right here an accrued expense. That's the type. All right. In fact, if you go up here, when we talked about accrued expenses, interest was one of the examples, interest accumulated. All right. So 2 things we're going to do. Not only am I going to show you or work through what the actual entry is, but some of this, we don't have a number here. I mean, we do, but we don't. We got to figure out, well, it's interest that we're talking about. Okay. And if we go into my other screen here for this illustration, and we look at the templates, all right, we've got one for an accrued expense. So if you have an accrued expense, you're going to debit an expense account and credit a liability. All right. So we'll get to that in a minute, but let's leave that template there. Right now, we have to know for how much. All right. Whoops. Let me just go back to that and go back to my notes. So we borrowed the money on September 1st, 2022. We're preparing the entries at December 31st, 2022. All right. So we have to calculate the interest. So that's the next thing I'm gonna put here. I want all that to be on one page. So let me just shove all this down so we got it. And again, I'll clean this up when I post it. So calculate the interest amount. This is how we're gonna do this. We're gonna take this formula that you might remember from another, like a math class or something. Principal, right, times the rate times the time. And this is gonna give us our interest expense. All right. So we know the principal balance borrowed, that was 10,000, right? We know that the interest rate is 9%. And the time factor we have to figure out in terms of months. Okay, so we have all of September, October, November, and all of December. All right. So this is going to be 4 months out of a total of 12. All right. Now, I'm going to put a little asterisk next to the 4. Where's my cursor? There it is. And I'm going to go down here and I'm going to put that there and I'm going to say this represents September, October, November, and December. All right. Because one of the things I'm going to tell you about taking notes in this class, and this might actually extend on to other classes and be helpful there as well. Try to take your notes as if you're doing it for somebody who's not here. All right. So somebody who's not here is not going to know what that 4 means. Right. Now, give yourself an extra little notation, either draw a little arrow off the number and kind of write what it is. I used a little symbol here to bring it down here. But you're going to have to do something to remind yourself what that number is. Even at the time I'm explaining this, you're like, yeah, I know what the 4 is. A week or two later, when you're looking at the notes, you're like, where the hell did that 4 come from? All right. Don't put yourself in that boat. Organize your notes to tell a little story. Okay. So some of the stuff that might be a little weird in terms of like, where did that come from? I give a little extra narrative in there. And then 12, of course, is going to represent 12 total months of the year. All right. So then that's the formula. So I'm going to get my calculator out and let's punch it in. So I got 10,000 bucks times 0.09, the decimal equivalent of 9%. That gives us that number. Going to multiply that times the numerator of the fraction, which is 4, and then divide by the denominator, which is the 12. And our total interest cost is 300 bucks. Okay. That's the magic number we need. All right. Now that we have that number, now we can prepare the journal entry. Okay. But how do we do that? When we go in here, the template says debit an expense account, credit a liability account. Knowing what you know about account titles and knowing that we're recognizing interest, what would I call that expense account? What would I name it? Venture a guess. So we know we need an expense account. So we know that the word expense is going to be in the name, right? What are we expensing? Well, when we go back to the notes, what we just calculate? Interest. There's your account title, folks. Interest expense. All right. And if we don't pay that interest, what would be the liability account name that seems appropriate? And again, be specific. Because you might say accounts payable. Well, I'm not saying that is incorrect, but we need a liability that's specifically related to the interest. We would call it what? Interest, what? What's the word we usually use? There it is. Interest payable. All right. Now, again, if that you're like, wow, I had no clue. Don't worry about it. It gets better as we practice it. So I'm taking the template and kind of having you, dig into your knowledge of account titles and connecting the dots there as to what would the account titles would be. And that's what they would be. All right. So we're going to say our entry is going to debit interest expense, and we're going to credit interest payable. All right. And I'm going to go ahead and we'll put our numbers in here. This is 500 and we'll put 500 down here. All right. And then I'm just going to indent that guy. I'll try the tab, but again, it kind of goes over too far, but that's okay. Yeah. So there's your journal entry. Oh, 300. Yep, sorry. The other 200 is from the accountant, that got fired because he tried to expense off more and he pocketed the 200 bucks. No, I'm just kidding. No, that didn't happen at all. All right. No, it's 300, not 500. Okay, sorry. So yeah, so there's your debit, there's your credit, there's your adjusting entry. Okay, in fact, just above that, I'll put adjusting entry needed. All right, and I'm gonna change the font down a little bit, bold that and underline it. There we go. And let me save my file here before I lose everything I just typed. All right, chapter 3 notes. We're gonna throw that in the old upload folder. There we go. Nope, we're not gonna replace it. Let me see. I'll throw in my downloads. There we go. All right. So there's your first adjusting entry. All right. Now, again, this is an in-class thing. We're working through this because it's not just about what the debit and credits. Like some of these, you got to figure out what the number is. All right. All right. So there's your first one. I'm going to copy that whole thing so we can keep the format consistent. Obviously, we're going to change a bunch of stuff for the next one, but let's go ahead and copy that down. And then we'll call this adjusting entry 2. And I'll delete the type until we know what we're dealing with. And then I'll paste in what we need. All right. So the second item in the drill problem, all right, says account of supplies. Whoops, I got to drag over a little further here. Let me try that again. All right, let me copy that in. We'll put it right in this information here. Account of supplies on December 31st, 2022 indicates that supplies of 900 are on hand. So let me give you a little supportive notes for this, okay? Before we actually do the entry and figure out what we need. On hand means leftover, right? But sometimes students don't kind of grasp what on hand means. That's what it means. It's just what you have left over. All right. So if 900 bucks is what we have left over, how do we figure out what we started with? Well, that's where we go back into the problem and we go all the way up here to the beginning information and we're talking about supplies. So here we see supplies. All right. We see supplies and what I'm going to do is I'm going to screenshot just that little snippet and I'm going to pull it into my Word file. But before I do that, I'm going to take a little shape and I'm going to select that like that. And we'll throw a little border on it. And let me take all of that right into our Word file. All right. So this is our beginning balance, right? 2,450. So the reason I got that in there, and I'm going to bring this down so it's all in one page. The reason I got that in there is to support the calculation. Calculation is this. Take the total number of supplies we have, subtract what we have on hand, and this is going to give us what we actually used. So what they're doing is they're giving you what you started with, what you ended with, and the difference must be what you used, aside from any employee theft that may have taken place, which we'll assume didn't. That's also known as a variance or shrinkage, okay? All right, so we take that 900 out, and we end up with 1,550, all right? And this is the supplies used, which is what we're looking for. In this journal entry, we're trying to figure out how much supplies got used up. Now, before we go any further, we got to put a label on this. What type is it? Well, first off, is it revenue or expense related? It's what? Expense or revenue related? When we use up supplies, it's what? Yeah, it has nothing to do with performing a service, right? It's about using up supplies. So now we're down to, is it an accrued expense or is it a prepaid expense? Yeah, because When we bought the supplies, we bought them up front. They went on the books as an asset, and now we're charging to expense some of the supplies with use. So this would be a prepaid expense. All right, because remember, we got to, and I should have done that first, but we kind of backpedaled and put a label on that. All right. Now that we know that, and now that we know the number we need, because that is the number, we're looking for the amount that we used up that we need to charge to expense. Let's go in here and go to the prepaid expense template, which is right up here. We have to debit an expense account. All right. And then we have to credit an asset account. All right. So if I'm looking for something expense and it was supplies that were used up, what would be my account title? Supplies expense. I like that. All right. That's right. And if I'm going to credit or decrease an asset, which asset makes sense that we would need to decrease? Supplies. Yeah. Because the question is, given this information, do we have that total in supplies anymore? We don't, right? That's what we originally had. Come on, Word. Don't suggestive. There we go. Jeez. All right. We got 900 left over. We had that to start. If we don't adjust this supplies account down, it's still going to show this balance. It's still going to show that we've got that in there. So we got to take that much out of it to bring it down to that. All right. So our supplies account actually reflects what we physically got. That's what we're trying to do here. So first things first, I'm going to go in and just put those numbers in there. Now we know obviously the other numbers are changing, but let's go ahead and get that number that we need in there. All right, there it is. All right, now obviously we're changing our account titles. This is going to be supplies expense, and the credit is just going to be supplies. Okay, and there's your adjusting entry. Okay, so one of the things that you notice with this chapter, chapter 2 kind of just gave you the number, and you just had to figure out what accounts to debit credit. Here, you kind of, for some of them, you're going to have to figure out what that amount should be. All right, so again, with this one, this is what we started with. This is what we had at the end, and we're charging to expense what we used. All right, what we used up. Now, one little gotcha with this. Some students would see this and they would actually accidentally take that 900 and charge that to expense. All right, oops. Yeah, because you're charging to expense what you actually physically have left and ignoring the stuff that actually got used. So you literally got the opposite of what you're supposed to do there. Okay. All right. All right, let me grab all of this and let me pull in and do a little more here. Let's go down and paste this in and do the next one. So, and again, I'm going to go down a whole line because I want everything literally on one. Yeah. I'll fix it all after the fact. So this is adjusting entry number 3. So I'll delete that out. This isn't going to be pertinent anymore, nor is this. All right, so let's clear the slate a little bit. And let's grab in the actual transaction. All right. So the next one, depreciation. Okay. Well, let's get it into the notes first here. All right. Depreciation on the equipment for 2022 is $1,000. So the question is, before we do anything, what is depreciation? All right, what is it? Well, I'll tell you what it is. It's something I can't spell today. There's that. All right. This is the measuring, or I'll say the value of the wearing out of an asset. All right, that's what it is. All right. The wearing out must be charged to an expense. All right. I have more to tell you about this, because this is a weird one, because it involves a brand new account you've never seen before. All right. So there's the first thing, identifying what it is. So when we have stuff that assets that we buy, we've got supplies that we use up. We have prepaid stuff that we use up, like insurance or rent. But what if we bought a building? Okay. like a 10-story building. That doesn't work the same way, right? You know, say, yeah, we've owned that building for 5 years. We used to have 10 floors, but it's been depreciating, so now we only have 6 floors left. You know, that's not how that works, right? You don't start taking out floors or bricks or anything like that. That's going to stay what it is, but it's going to wear out with use. And there's a lot of depreciable assets. You know, vehicles, parking lots, driveways. These are all short-lived assets. They have limited, you know, service lives. And, you know, excuse me, at some point, they have to be replaced, okay? So a building might last 40 years, a vehicle may last, you know, 7 to 10 years, and then eventually you'll have to replace it with a new vehicle or a new building, okay? But there's other depreciable assets, computers, copiers, furniture, office furniture. All those things are subject to depreciation. Now contrast that with stuff like supplies. Supplies get used up. When you use up all the supplies, all you do is turn around and buy more supplies. They don't depreciate, they don't wear out, they get used up. So that's the difference, okay? So, couple things. Depreciation expense, whoops, is the typical expense account used when recognizing depreciation. Whoops. All right, and here is the new one. Accumulated depreciation. Well, I really can't spell that today. Is the other account used. All right, so we already know what we're going to have in our adjusting entry, right? So I'm just going to go ahead and put it in there. All right, we still don't have a number that we haven't evaluated yet. We'll get to that in a minute. So the adjusting entry is going to be depreciation expense. And then the credit is going to be this accumulated depreciation account. And I'm going to tell you a little more about that because I have some more notes for that. All right. And let me just hit this, go back a little bit. There we go. All right, so there's our adjusting entry. We still need an amount. Well, they told us up here, $1,000, $1,000 for the year. There's your number. So I'm just going to go in there and throw that in. Some things require a calculation, some things won't. This is one where they just kind of gave you the figure. Now, when you take Accounting 102, I'll show you how to calculate that. There's a few different methods that you can employ to get that number. Okay. Let me save real quick. All right, so so that is the number that you need, and there's the debit and credit. But let's talk a little more about this. I'm going to give this some bullets here for this because there's a few things I want you to know. This is a contra asset account type. All right, contra means opposite or offsetting to the account it's related to, which would be the asset account. All right. So if I have equipment and it depreciates, all right, the accumulated depreciation account is a contra asset to that equipment account. So equipment is an asset with a normal debit balance, which means accumulated depreciation would have to have a normal credit balance. So that's the next thing. Has a normal credit balance. And again, reinforcing what that means, credits increase, debits decrease. All right, just like we did in chapter 2. All right, so definitely some new things about that, because that is something that's brand new in terms of an account type. We haven't talked about contra accounts yet, and there's our first one. You'll learn a couple other ones in this course before we're done. Okay. All right. So the other thing is, sure, I can give you notes for all this up front and then do a drill problem. I'd rather take a nice sample drill problem, look at a situation, give you notes about the thing you're dealing with in that situation, and then generate the entry from that. So now, going over, we don't have a type yet. Certainly, this is related to an expense, not a revenue. We didn't perform a service. We don't owe a service. We have something that is an expense-related adjustment. Now, when we talk about taking depreciation, we're talking about a deferral. We're delaying the depreciation expense on, say, that equipment or land or whatever, or not land, that doesn't depreciate. Equipment or buildings or whatever we put on the books as an asset. The wearing out, the measuring of the wearing out or depreciation takes place later. All right. So that's why, again, another reason a prepaid expense is a deferral. All right. And that's what it is. It's a prepaid expense. Because yes, it does involve, well, here, hold on a second. I'll go back to our notes up here. Okay, way back when. Prepaid expense, where's my cursor? There it is. Did we acquire an asset up front? Sure, you bought the building, you bought the equipment. Yep. That we will charge to expense with use later. Yes, as you use the building or the vehicle or the copier or the office furniture, you're going to have to allocate a value of wearing out. Okay. How much it wears out. Some are easier to measure than others. Like if it's a vehicle, you can measure the wearing out by the miles driven. All right. Furniture is a little difficult because you're like, well, what? The number of sittings on the couch? How's that work? So how they get the numbers, again, in 102, I'll show you how we deal with that. But the numbers they give you are the numbers that you just simply use at this level. But yeah, we did. We bought equipment or whatever it was up front. It was equipment, I think, right? Yeah, equipment. And yeah, as we use the equipment, it's going to wear out with use. Okay. So, and of course, there's our adjusting entry that's needed, and accumulated depreciation is credited. Okay. But there's everything you need to know about accumulated depreciation. Okay. All right. Maybe we can do one, possibly two more, but I'll go ahead and talk about what we're going to do after that. Let's go ahead and do one more here. Yeah, one more sounds good. All right, well, first things first, let me go ahead and copy all of this to kind of keep it templatized, so to speak. We'll do that first. All right, I'm gonna go down, paste that in. All right, so now this will be adjusting entry number 4. Get rid of this because we don't know what we're dealing with yet. All this stuff I just wrote, I don't need, so I'm just going to go ahead and delete it all. So we have nothing but just the entry and then the actual transaction, which again, I'm going to copy. So this is number 4. All right, copy, put it in there. All right. So the next one, Devin Wolf paid $2,100 for 12 months of insurance coverage on June 1st. So it looks like he or she paid up front for insurance. Now, when the insurance is paid up front, it goes on the books as a what? Do you remember? You pay up front for something, we put it on the books as a prepaid expense. Yes. But what is that generally? It goes on the books as what? Remember your types: asset, liability, owner's equity, revenues, expenses, drawing. Which one would it be? And why? Well, let me throw this at you. If I pay upfront for insurance, is that insurance going to benefit a future period of the business? Yeah. So what is something that has future value and benefits the business? That's an asset. Yeah. Right. Yeah. Rather than just telling you, I want you to reason it out, because that's part of the skills here. So yeah, this would be a prepaid expense. So what happened was we bought an asset up front, right? And yeah, by prepaying for the insurance, we paid up front for coverage of future periods insurance, that's gonna cover us. It goes on the books as an asset. All right. Now, once it goes on the books as an asset, what are we gonna start doing? We're gonna start using it, right? How do you use the insurance? Well, the only way you can quote unquote use it is the time goes by that you have bought coverage for. Okay. So as each month goes by, we use up 1/12 of our insurance, right? All right. So that's the key here. So one of the things we got to do is we've got the amount that they paid. We're doing the adjusting entry at December 31st. Okay, so I'll remind us that adjusting entry is being prepared on December 31st, 2022. All right. I threw that little extra blurb in there. It's not part of the original transaction, so I'll just push it down here. Now, when did we buy the insurance? What date? When did it go on the books? June 1st. When are we doing the adjusting entries? How many months have gone by between June 1st and December 31st? And use your fingers if you want. June, right? July, August, September, October, November, December. How many? 7 months. All right. So we're going to put that little blurb in there. 7 months have gone by since the insurance went on the books on June 1st to the end of the period of December 31st. Yeah. Let me fix my spelling of December there. There we go. All right, so 7 months have gone by. All right, this is important because this tells us, all right, we prepaid for that insurance. At year end, 7 of those 12 months have gone by. So that gives us a clue what we have for insurance. I'm going to take that $2,100 total amount and I'm going to multiply it times 7 months out of a total of 12. I'm going to take what we call a prorating fraction. All right. And I'm going to put a little asterisk here and I'm going to put a little asterisk there that ties that in. So now you know what the 7 means. All right. That's why I have that wording just above that fraction calculation. All right. So let's find out how much of that 2,100 we actually used. So that 2,100 times the numerator divided by the denominator, and we get a total of $1,225. And we'll say the amount of insurance used up. Because again, you're just buying coverage. Now that we know how much has been used up and we know it's a prepaid expense, let me go to the template. And there's the prepaid expense template. We're going to debit an expense account. So we need something expense. What would that be? Insurance expense. Bingo. And then we're going to credit or decrease an asset account. Which one makes sense that we would have to lower now that we used up some of it? It would be what? Well, let me help you. We go back to the problem. We go up here to the top. Prepaid insurance. So this is an asset account. That value went on the books. All right. That's the account that we have to reduce because, well, let me ask you this. At December 31st, do we still have $2,100 worth of value in there? No, we used some of the coverage got used up when we know how much. Yeah. $1,225 of that 2,100 that we prepaid has now been used or expended. Therefore, we need to charge that to expense. All right, let me see. And again, like I did before, I'm going to push that down so everything's on one page. So our expense account is going to be insurance expense. Again, right from the template, something expense. What are you expensing? Insurance expense, done. And then we have to decrease the prepaid insurance asset account, because if we do not, then prepaid insurance is still going to show that $2,100 amount. It, it's going to still show the balance. Where is it? That we have right there. And we know that's no longer true. We had 2,100 in there, but after 7 months have gone by, we don't have 2,100 used now. We have to adjust it. So by decreasing by the amount we used up, we leave on the books what we have left, which, again, if that's the original amount, just to kind of drill this home a little bit, we started with 2,100. I'm going to subtract what we expensed off with use, and that's how much we have left to use. $875. All right. Now we got 5 months left. All right. 5 months left. Now there's another way to do this. You could do it this way. You could say, all right, that's 2,100 for 12 months. I could go in here and take 2,100 divided by 12. And what that's going to give me is the monthly amount of insurance cost. And then I could just multiply that times 7 and get the same darn number that we did with the prorating fraction there. All right. This one, I think it's easier to use the fraction because it's kind of a one and done. A single calculation that gets you right to the number you need. So that's the number that goes in here. And then there we go. So you debit insurance expense, you credit the prepaid insurance account. All right. So this is what I want to do. When we get together next Tuesday, I'm going to finish this problem. Okay. So we've got like 3 more things to do in there. All right. So we will finish this problem. And I'll post the notes of what we got so far as in addition to the class recording. So while I'm taking attendance here, because that's the next thing I got to do, let me talk about what we're going to do in the next class. I'm going to give you another Wiley Plus assignment. And this is going to be something that is pretty basic stuff that supports what we did today. Okay. In the assignment, you won't have something that you're tasked to do that we haven't already covered in class. All right. So I'm not going to give you any kind of an adjusting entry we haven't had a chance to work through and look at. But I will give you some stuff that we have done. You'll have a different question or exercise that kind of tasks you on what to do for the journal entry and get the amount, just like we did here. And I want you to be able to practice what we've done so far. When we get together on Tuesday, we'll go over the rest of this problem we're working through, the other 3 transactions, and then we'll practice this some more. We'll take a look at the homework, see how that went for you, and then we'll go a little further with this. Okay. So real quick, I'm going to save that file again because I'm paranoid about losing everything I just typed. And I'm going to hand you, the students in class, I get the attendance sheet. Zoom folks already got your attendance. I'll start. Yep. You guys go ahead and sign that. And that's what I got going for you for our next class. So look for that update soon. All right. I got office hours right after this. So, and I do have a student I'm meeting with. So I may be able to get to it before the meeting with the student. I might not. But if I don't, immediately after I'm done meeting with the student, I'll get it updated. And as always, I leave you with a couple dad jokes. Albert Einstein was a genius, but his brother Frank was a monster. That one you kind of have to think about. All right. Well, Halloween's coming, right? So I wanted to throw, there will be more Halloween themed ones. Here's a good one I like. I took my wife to an apple orchard and we stood there staring at trees for more than an hour. Apparently this was not the Apple Watch she was expecting for her birthday. All right. That's a good one. Yeah. Why did the chicken like to go to the gym? He liked to work out his pecs. All right. And my favorite for today, what does a weak man put on his steak? Worcestershire sauce. All right, there you go. All right, folks. Thanks once again. Yeah, there you go. Frankenstein. Yep. A little play on words there. I love it. All right, I'm gonna go ahead and stop the recording.